Hey guys, Steve Ferguson, Thrive Mortgage. Hope you guys are having a great day today. Today we're going to talk about a two-time close construction loan. So let's get started. So what a two-time close means is there's two separate closings. There's the closing that you have for the construction and the land, and there's the takeout loan that you have when all the construction is finished and it converts it to a traditional mortgage loan. So let's start with the first closing. So you're out shopping, you find the perfect piece of property, you love it. You find a builder you just love, you've got the floor plans all put together, and you're like, yes, I want to get this built. I want my family to have this piece of property in this new home. So what you do is you do what's called a construction loan. And so in that construction loan, it takes the cost of the land and the cost of the construction, and it rolls them all together into one closing. And that's called a construction loan. So what happens during this time is usually it's a modified interest rate. It could be interest only. It just depends on the product that you decide to use. But during that time, 6, 9, 12 months, however long it takes to build your home, that home is just getting built. And so you're waiting for it to get finished, et cetera. And at the point in time that the house is finished, now you go into your takeout loan, which is your second closing. So the takeout loan takes all that construction, the home being finished, and it rolls it out and via a refinance. It's not even a purchase anymore because you've been on title for a certain amount of time, and it refinances into a traditional loan, whether it be conventional or jumbo or whatever it happens to be at market rates. So the beautiful thing about a two-time close construction loan is it gives you a lot of flexibility. So during that construction phase, if you have modifications to the house you want to make, or 3 months in, you're like, hey, I want to move walls, or I want to change flooring or whatever that may be, you can negotiate that with the builder and build that into your construction loan a little differently. And then on your takeout loan, it can be compensated for at the very end. So it does give you a lot of flexibility. The downside is you've got two sets of closing costs, right? So you've got your closing costs for the first loan, which is the construction side, and you've got your closing costs for the takeout loan, which is your traditional style financing. So you do have increased costs. The other difficult thing about a two-time close construction loan is interest rates. Depending on how long your house takes to build, as interest rates change in the market, your rate's not protected. So unless you're doing a long-term rate lock or some other type of product to protect that interest rate, then you're subject to whatever the market is doing. So it's a great product. It gives you a lot of flexibility, but just keep in mind there's pros and cons to every product out there. Well, I hope this, guys, explains the different products that are out there for the two-time close construction loan. And if you have any questions, call anytime. Talk to you later. Bye-bye.